credit rating agencies played a big role in the financial meltdown a few years ago by giving out bogus ratings on investments that turned out to be junk. Now regulators are taking on a year-long study to examine whether to even require ratings in the future. Brian Battle of Performance Trust Capital Partners and Rebel Cole of DePaul University are here to debate it. Welcome to the show, both of you.
Thank you.
So let's start out with what is existing today. There are 10 firms registered with the government as official credit rating agencies. They're, of course, dominated by the top three: Moody's, Fitch, and Standard & Poor's. Brian, let's go over your idea.
Sure.
Here's your idea. You think, you say that on structured products alone, these are securitized products like CDOs where these investments are bundled together.
Right.
You say ignore the rating on those completely by these credit rating agencies. Find a reliable third party to price the assets and then publish the results. What would that accomplish?
Right. So let's remember that in the financial crisis, we didn't have a problem with ratings on corporate debt, municipal debt. That's single obligor, where there's one payer. So all the problem occurred in this really complicated set of assets where everything's smushed together. So what we should do is have the Federal Register decertify ratings for those kind of assets and then find a third party to price them to determine their value for regulatory purposes. Now, we already have a model for this in the insurance industry. They had exactly this problem. They had a bunch of assets that had been downgraded, mortgage-backed securities, and they picked PIMCO to price them. So PIMCO didn't even have a rating. They just gave them a price, and then PIMCO published what price the bonds were worth, and then that's the valuation that everybody used going forward. So it solved the regulatory problem and used the market to find a third-party verifier. So it also solves the problem for the regulators that they don't have to go line by line and try and figure out what all these complicated things are, because you have guys out in the field, you know, looking at Excel spreadsheets trying to figure out what the assets are worth. Instead of doing that, you just have to know who reliable pricing services are, and then the regulators can depend on them to figure the pricing.
Rebel, is that a strategy or model that would actually work across the market?
Yes, I think it would work pretty well for most of the market.
But there's, I mean, who's held liable? I mean,
Well,
you've got to, if you're going to put your stamp of approval on an investment, who's going to be held liable? And can we hold someone liable?
The real problem is one of financial literacy, in that these bond rating agencies are issuing what's really an opinion. It's not an expert opinion for which they're legally liable. One of the provisions of Dodd-Frank actually removes that exemption from legal liability and makes it an expert opinion, which the bond agencies will be responsible for, and that's had some very pernicious effects, freezing up the bond market.
What about the conflict of interest? Brian, is the conflict of interest always going to be there?
Sure, if the issuer pays, you're always going to have a conflict of interest. I don't think anybody in the market is ignorant of the fact that there is a conflict of interest. You know, where it became a problem is in structured finance. The rating agencies all were trying to get market share. They have stock prices, and they all competed to try and get this new, growing, burgeoning market, and that's where they fell down. So the conflict of interest is always going to be there. The only place you could relieve that is to try and figure out what Morningstar has done. They've gone out and they publish research on stocks and mutual funds, and you subscribe to that and you buy that. There's some resistance in the bond market for that, because it's hard to know if anybody would pay for a credit opinion if they can get it for free from Moody's and then ignore it or use it at their whim.
Okay, in the end, after this year-long study, Rebel, are you convinced that the regulators are actually going to get this right and really overhaul credit rating agencies?
I don't think so. I think they're going to go back to using the credit rating agencies when it's all said and done, because there's just no good alternative out there.
Yeah, Brian?
Right, and that's my fear too, is that, you know, right now the regulators say the ratings are worthless, they're rotten, you can't use them, but we're going to use it to set regulatory capital structures. I think they're going to default to that. That's bad logic, but I think they will default back to that because, as Rebel said, there's no good alternative unless the regulators are willing to listen to the street. And we're going to render an opinion that maybe they should do it on a two-tier basis and just use evaluation services instead of going with the rating.
Bottom line, it's buyer beware. You really can't trust any rating at all.
Exactly.
It's really one of financial literacy. These are opinions, and treat them accordingly.
Okay, thanks very much. Rebel Cole of DePaul University and Brian Battle with Performance Trust Capital Partners. Thank you very much.